market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, oil holding on to gains this morning after President Trump made sweeping new demands of Iran. In response to Tehran's request for reparations, he's called on Tehran to pay compensation for deaths and damages stemming from regional conflicts. Now, for more, we're joined by our Abir Abu Omar in Dubai. Abir, look, it's been a couple of days. It's really unclear exactly what the demands are. Is this economically, or is this just broken trust amongst the two sides?
Good morning, Francine. Two very good questions. It's a mixture of both, really. So you did mention that over the past 2 days, we've heard new remarks, namely from President Trump, saying that he will wait for the economic toll to take its weight on Iran, essentially, and that would somehow bring Iran back to the table. Now, from the Iranian side, as a matter of fact, we've had even more maximalist demands over the weekend with the reshuffling of some hardliners within the government. Now, Iran, through those hardliners, is asking for compensation for the war, is asking for the U.S. to lift its naval blockade, is also asking for the lifting of those oil sanctions, unblocking those assets. President Trump, in his latest remarks, as you can now see, says that, well, if Iran asks for this, the U.S. will ask for compensation for all the people that have been killed and gravely wounded throughout the war. And over the past 50 years, he also names the protesters. He also says that Iran is in charge of the casualties and of the tragedies in neighboring countries, including in Yemen, Syria, Lebanon, and even Gaza. Now, he didn't give a lot of clarification on what exactly that means. But what is for sure is that we're seeing this deal that we've been talking about over the past few weeks at this point really drifting further away from coming to reality. We've reported that a discussion between Oman and Iran has been taking place about a mechanism to reopen the Strait of Hormuz. Now, the latest we know about that is that negotiation is in the final stages. We've reported that over the past week or so. We still have no clarity on just how close it is to that finish line.
So, Abir, actually, sometimes you have a lot of negative press because it's a domestic audience, and then behind the scenes, it's a little bit more optimism, or there's a little bit more progress. Is there any sign that things are getting better behind the scenes?
Not really is the short answer, Francine. What we know is that the only negotiations taking place are, as I mentioned, between Iran and Oman. Iran is adamant that Washington is not part of those negotiations. And what we also understand is that there are no formal discussions taking place between both sides of the table. Since that MOU was signed in Switzerland, our understanding was that the two sides are going to come and start discussing those concessions, namely that nuclear component that was top of the list. That hasn't gone anywhere. As a matter of fact, that deal or that MOU, the interim agreement, all the concessions have really left the window since those escalations restarted in the Middle East. For the time being, front and center is that mechanism to reopen the Strait of Hormuz. President Trump to Bloomberg yesterday in the White House saying that the Strait of Hormuz is open. That is something that obviously Iran refutes adamantly. And then you have the fact that this war is still ongoing, but not just that, the parameters of the conflict have been expanded in the region, with the Yemen-based Houthis now hitting countries, including Saudi Arabia, including the Red Sea, another crucial waterway that Saudi Arabia had resorted to ship its crude exports throughout the course of this war. So now you have Bab el-Mandab, another crucial waterway alongside the Strait of Hormuz, getting exposed to those threats by Iran-backed militia, and so further putting upside pressure on Brent crude prices that are edging very, very close yet again to the $90 on the barrel mark. And so no signs of positivity as of now in the Middle East. But as you have seen over the past 6 months or so, things could happen at any given minute. And so obviously those are things we'll continue to monitor and update with.
Abir, thank you so much. Abir Abu Omar there with the very latest on the Strait of Hormuz. Now, Nvidia has partnered with some of the biggest firms on Wall Street to unlock up to $500 billion for AI infrastructure. I mean, we say this like this is normal, $500 billion. Meanwhile, Intel is increasing the size of new share sale to about $20 billion. Let's bring in Matt Bloxham from Bloomberg Intelligence. Matt, we do need to check ourselves sometimes because we used to speak in like hundreds of millions and now we just throw billions around. So what do these funding plans actually tell us about current AI sentiment?
It tells us that the AI economy is still incredibly hungry for capital wherever it can get it from. I was looking earlier at how big the vendor financing market is. I think it's less than $100 billion. So, this would kind of dwarf the entire vendor finance community. So we need to see lots more details about actually what this is finding. But it does add to this kind of uncomfortable situation that the AI economy is becoming increasingly circular. Potentially, you kind of create some systemic risk here that, if the whole of the finance community is backing AI and that suddenly demand slows down on this bubble, then suddenly the implications could be much broader than a small group of big technology companies.
I mean, also on AI spending, tell us about Anthropic's deal with Riot Platforms.
Yeah, so Riot Platforms, probably not many people have heard of. It's a Bitcoin company. To mine Bitcoin, you need huge amounts of compute. They've seen the near-term supply constraints on compute capacity for AI. All of these big tech companies are in the market for compute capacity, and they've seen there's a better return on their investment by doing a long-term deal. So $9 billion a year that Anthropic's paying them for 20 years to access just short of 200 megawatts of compute capacity. So it helps Anthropic deliver against near-term customer needs whilst they invest for longer-term capacity from other sources. And we've seen a number of these deals happen. XAI, SpaceX has been selling marginal capacity at their Terafab unit just to kind of help with this too.
Matt, as ever, thank you so much for joining us. Matt Bloxham there from Bloomberg Intelligence on everything tech and AI related. Now, bonds edging lower as a rally in oil prices revives inflation concerns a day before the release of some key U.S. consumer price data. So we talk about that. We talk about the Strait of Hormuz. And, of course, we talk about tech with Grace Peters, co-head of global investment strategy at JPMorgan Private Bank. Grace, as always, thank you so much for being with us. I mean, I do think these two themes are running, but now I don't know whether you find the labor market in the U.S. in equilibrium more or less. I know a lot of people dropped out of the force, but is that why there's so much inflation focus?
No, I don't think it is. I think what we're seeing now is actually an enduring shift in the composition of growth in the economy. The consumer, which traditionally has been the big engine, roughly 70% of U.S. GDP, I think is actually falling back. And in its place, you're seeing this capex surge, in part driven by AI and these colossal numbers that you mentioned, billions moving to trillions. Probably, if we look forward, but also driven by spending needs around issues of national security. Right. But what this means from an inflation perspective is, I think, when we think about services versus goods, we're watching the goods side of things. I think we got from the non-farm payrolls last week confirmation that the labour market is ticking along. It's a bit lackluster. It's okay. It's okay. Yeah. But wage growth actually down to around 3%. That is consistent with the Fed's mandate, in our opinion. So actually, services inflation, I think, is more contained. We're watching goods price inflation, not just in this print, but on a go-forward basis, because of some of the spending, because of some of the bottlenecks. Things like memory pricing has obviously shot up, and everything going on with the Strait of Hormuz and oil price close to 90, second-round impacts there. But, so far, inflation expectations feel anchored. I think that the Fed, we describe it as a bit of a coin toss between whether they hike or they don't, but relative to market pricing, we'd take the under. But the big picture to us is that we are in a slightly higher inflationary but higher nominal growth world, which has implications for the investment decisions you're making.
But so that, in terms of what the Fed should do, is it's probably, as you say, towing costs are actually not moving.
Yes.
But then bond markets are giving us a different signal.
Yes, I think within the bond market, when we think about the shape of the curve, the bit that we like to invest in at the moment is really the front end. So if we think about out to about 5 years, because we're playing that notion that we'll take the under versus market pricing on the Fed. I think when you look further out, these forces, these dynamics that I mentioned around higher spending, that obviously has implications for deficits. So I think we do need to think about the potential for the curve to re-steepen. Yeah. And obviously we've got a new Fed chair, and the market's still trying to build trust and build credibility, in chair wash. And so, again, that can affect the longer part of the fixed income curve. So fixed income, I think, to us is for income, but when we think about really benefiting from some of those dynamics, the expenditures, the capex, we like other parts of alternatives, infrastructure, we like hedge funds and even gold, which is having a little bit of a revival of late.
It certainly is. Infrastructure, what part of infrastructure?
Yeah, so we like core infrastructure, because what we're trying to tap into there is this higher nominal growth world, contracts which have got some inflation protection, and if you're thinking about a high single-digit total return, the vast majority of that comes from the income component. But I think there's another way to invest in infrastructure, which is really in power. We talk a lot about AI bottlenecks, and to us, power also fits the bill there. So you're seeing, big developments, renewables, as well as traditional forms of power. And so that's another way we think infrastructure assets can complement the portfolio, reduce the correlation, we hope, to equities as well, and provide that income component.
I mean, overall, actually, earnings, I was looking at earnings. I mean, sure, they've been dominated exclusively by big tech, but actually it's kind of given a boost by most sectors.
Yes, I mean,
which is surprising.
I don't know if it is surprising, because it feeds into this broadening theme of, the capex that's coming from various sources and is diffusing across the economy. So you're quite right, Francine. If we look at median earnings growth from the S&P, we're up to 13%, which I think is very encouraging, reflecting this breadth. And just the scope of the upgrades is pretty unprecedented. You don't get double-digit upgrades, really, outside of recovery periods, when you've had a recession and analysts are underestimating the V-shaped recovery thereafter. So, our call beyond the capex super cycle has been an earnings super cycle, and we certainly feel in the second quarter we've got that. We think that will continue to lend support to equities, global equities. We like the US and emerging markets particularly. But, all of these things, the higher nominal growth, higher inflation, does mean it's a higher cost of capital world. So you also need earnings. You really need those earnings to come through.
Grace, emerging markets, I mean, do you make a difference between the countries that are very exposed to oil, given there's no end in sight in the standoff between the US and Iran?
Yes, to some extent. I mean, I think emerging markets have proven to be less oil dependent than perhaps people would have expected, and the earnings upgrades have actually been some of the largest in emerging markets linked to AI, obviously in regions like Korea and Taiwan. That's obviously tied a lot to the momentum trade, where we've seen it sort of wash out over the last few weeks. But we think the fundamentals there are sound. Even beyond AI, we think that the backdrop, the macro backdrop, the central bank backdrop is a sound investment proposition. And so to us, that's a really good barbell for US equities. Europe, I think, is not to say we're negative. A rising tide should lift all boats, but I would have a preference for the US at EM.
It starts from a lower base in Europe. So you kind of, every year we kind of say, well, this is the year for Europe.
There's always hope. And look, I mean, to be fair to Europe, quietly behind the surface, its earnings season has been robust, particularly the banks have done pretty well. So there's definitely stuff to like in Europe, and there's definitely hope factor, because I think if we go back a couple of years to the Draghi report around Europe's need to, sort of perhaps reduce regulation, certainly, sort of come up with a more coherent strategy, pro-growth, pro-productivity, there's definite hope there. We're just not seeing the hope just yet turn into reality. So the US and EM for us are preferred regions.
Great. I mean, we're 2 weeks and a half to the new government in the UK. Is the UK slightly different to the rest of Europe, also because they have these, massive commodity listed companies on the FTSE?
And I think this is a classic example of the economy is not the stock market, and that's particularly stark when it comes to the FTSE 100, where actually, it doesn't have AI exposure. So for investors who are worried about their AI exposure, the UK actually is an underweight AI market, and it does, as you highlight, have exposure to oil, mining, and also defence, to play one of the other capex-oriented themes. So I think there is a place for the UK or the FTSE 100 in portfolios. The UK domestic side of things I'd probably be less constructive on, but the FTSE 100's got some positives.
Grace, for the big AI names, I mean, do you worry about a correction? But as Matt was intimating, that could be systemic, or something like a systemic if it doesn't go the way we think?
On the glass half empty side, there's no doubt so much of this capex spending and the GDP growth and the earnings growth is linked to AI. But I would say, actually, in the last couple of weeks, AI's really passed a test through this earnings season. And we saw coming into earnings season this huge divergence between semiconductors that were doing very well and the hyperscalers, the companies really spending the money, being flatlining through the course of this year. And that's not healthy. The companies spending the money must be able to generate a healthy return. So the test that I think was passed through this earnings season is really that we got decent evidence that they are monetizing that spend through cloud, through backlog, through some of the management commentary around payback periods. And so I think that's encouraging. So I think that you're going to start to see, we like semiconductors still, but I think some of the hyperscalers will lift. Now, it's one hurdle. We're going to see plenty more of them. But I think, we've been big believers in AI. We continue to be big believers. But it's about investing through the whole value chain, the power, the cooling, the semis, as well as the spenders.
I know it's just one hurdle, but what do you see as the biggest hurdle? I mean, could China, and we're hearing, DeepSeek is actually raising prices, but is it a price pressure point, especially in this fight against China?
I think that there's going to be numerous things that we have to tackle. The big question mark is just whether there is a return on investment for these billions of dollars being spent. And as I say, I think our view is that you're seeing early and you'll see steady signs that will happen. Adoption across the US is only 6%. That's probably going to 30 to 40% over the next decade or so. So that's the first hurdle. But along the way, we're definitely going to have, sort of disruptive headlines, as you'd expect from technology, around pricing, around new models, and cyber issues as well, which is another sort of, I'd say cyber is more of a systemic threat when we think about the risks that the black swan events that we could see in markets. So it certainly won't be the last time the thesis is challenged, but as with all technologies, that is to be expected.
Grace, thank you so much as ever for joining us. Grace Peters, co-head of Global Investment Strategy at JPMorgan Private Bank. Now, coming up, an earnings boost and a warning about extreme weather affecting energy markets. We'll discuss the latest results from German utility Uniper. That's coming up next, and this is Bloomberg. So we have an earnings rebound this morning from German utility company Uniper. The firm says it's identified about 10 sites across Europe that could be sold or leased for data center development as it looks to capitalize on surging demand for AI infrastructure. Well, I'm delighted to be joined by the Uniper Chief Executive Officer, Michael Lewis. Mr. Lewis, thank you so much for joining us on Bloomberg. So you're looking to sell some of the idle coal plants to data center operators. Are you comfortable at the moment that you will get a good price, or are you starting to compete with other utilities for the same buyers?
Well, I think the most important thing, Francine, is that we've identified sites which are highly suitable for data center development. So this is a part of an ongoing strategy. We actually started way back in 2019 looking at sites. And as you know, we've been rapidly changing our portfolio of power plants as we move to more carbon-friendly technologies. And we've closed a lot of coal-fired plants. And those plants happen to be, A, in great locations, near conurbations, and B, have large grid connections, and C, have large areas of potential for development. So what we're doing with more than 10 sites across Europe is looking at how we can turn them into data center ready sites, which means clearing the site, having the grid connection infrastructure ready. And we're very confident that we've got some of the best sites in Europe.
And so you're confident that you'll get a good price for them?
Absolutely. And like I said, we have different models depending on the site. It could be a land sale. It could be a lease. It could be a lease plus a PPA. It could even be ultimately providing the energy infrastructure. So it's very much bespoke depending on the site. But we're very confident we have some excellent sites.
So Uniper was nationalized in 2022 during the energy crisis. The German state, we understand, will now launch a privatization of it. And we understand, according to Bloomberg sources, that there are around 10 bidders. Will the sale happen this year?
Well, that's a question actually for the federal government. We as management are responsible, A, for turning the company around since we were nationalized. As you say, after the energy crisis in 2022, we were rescued with a huge bailout from the federal government in Germany because of the gas being cut off by Gazprom. Since then, we've strengthened our balance sheet and we now have a very strong net cash position. And we have a very significant improvement in our credit rating. We have a strong operating result. Our half-year results to date, 711 million EBITDA, which is a significant increase on last year. And we have a clear strategy to invest the cash on our balance sheet. We have a 4.6 billion net cash position, which we will turn into new earnings through building new flexible power plants, new renewables, and rebuilding our gas portfolio, which we lost in the last crisis. And by bringing all of that together, we've solved the problems of the past. We now have a clear strategy and clear investments for the future. And that's our job as management. And it's up to the federal government to decide how they want to drive that privatization. But there are two options on the table. There is a sale to an M&A bidder, so to say, and also an IPO bid. And the government is currently in the process of looking at both of those.
Mr. Lewis, does Germany and will Germany have enough gas for the winter? And because a lot of the storage has been depleted, or are the discussions with the government to help storages fill back up?
Yeah, I mean, you're absolutely right. We have got a low level of gas in storage at the moment compared to normal levels. There are a couple of reasons for that. One, we exited the winter with a low level at 20% because we had some cold spells at the end of last winter. And secondly, clearly the crisis in Hormuz has driven up prices and sent the gas curve into backwardation. That means it's currently more expensive to buy gas in the summer than it is in the winter, which means there's no incentive to put gas into storage. However, we are seeing the forward curve come up a little bit. And of course, we're now starting to see people think about the winter and what we might do. And we have a target for 70% filling by 1st of November. We can still get there, but we do have to see the market prices move to incentivize the filling of the storage. But we're constantly in the market, we're constantly reviewing our position, and we're constantly looking at whether it makes sense to store more gas now. And I think storage is clearly one part of it. The other part is we need to make sure that the LNG flows to Europe this winter, and that's why we need a resolution of the Strait of Hormuz closure as soon as possible. We need a peace deal in the Middle East.
Have you already had to pass on those higher costs, though, from gas to customers, and how much higher can they go?
Yeah, well, at the moment, it depends exactly on what contract we have with customers. Some customers are on fixed price deals for a certain period, and they're all hedged and locked in. Other prices have a more variable component. Other customers have a more variable component. So it's very much dependent on the individual customer. What I can say is we've seen a very significant increase since the war in Iran started. Roughly the TTF gas price has doubled, and it's stayed in the region of 50 to 60 euros a megawatt hour. Like I said, that's why we need a solution to the crisis. We need the Strait of Hormuz to reopen, and we need to get LNG flowing across the world again.
Michael Lewis, thank you so much for joining us. That was, of course, a Uniper chief executive with the very latest on results. Now, coming up, Ukraine and Russia make strategic strikes against economic targets. So we'll discuss the latest from the region next. A look at what we're seeing on the markets. If you look at global stocks, they're actually, churning. Oil gains are stoking inflation concerns. Again, I guess global stocks posting some small moves. Government bonds are edging lower as we've seen this rally in oil prices really reviving some of the inflation concerns a day before the release of key U.S. consumer price data. Also, we keep an eye on what's happening in the Strait of Hormuz because President Trump says there are new demands on Iran that have clouded the outlook for a deal to reopen Hormuz. So we'll have plenty more on that shortly. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump hits Iran with sweeping new demands, including a call for compensation from Tehran, dimming hopes for progress on the Strait of Hormuz. Bonds fall and gold rallies ahead of a key U.S. inflation report tomorrow. Plus, Nvidia secures $500 billion in funding for AI infrastructure. Now, UBS is set to find out how far a group of Swiss lawmakers will back a dilution of the government's proposals on capital reform. Let's get more with Miriam Balezu, Bloomberg's Swiss finance reporter. Miriam, so good to speak to you. So what exactly is at stake in today's vote?
So we will get a little bit more clarity today. It's not the final outcome, right? It's one step of the deliberation with the Parliament, but we will have a little bit of clarity on where, for the trajectory of UBS's future. The core of the debate is the capital requirement, the backing for the foreign subsidiaries. At the moment, UBS only has to back its foreign branches with 60% of capital. and the Swiss government wants to force it to 100, which obviously is huge for UBS, and the bank's been lobbying for over a year actually, stating that it would completely damage their competitiveness both nationally and internationally, and arguing that they need it to be much lower. So that's what's being debated currently in Bern today. We're looking at the parliament potentially lowering to 60% or 80%, it's unclear. But today it's not going to be the final outcome, but we'll have a bit of an idea of where, which Swiss lawmakers are backing UBS, basically.
Yeah, so Miriam, I mean, this is huge for UBS. So what kind of impact could the vote actually have on UBS?
And first and foremost, I think, is the share price. It's been struggling, it's been lagging its peers for quarters on end. And I think investors are keen to get a bit more stability, to get back to the level that UBS were before these capital discussions started over a year ago. So today we'll get a bit more of a flavor of whether or not these measures will be diluted, and that will definitely change the trajectory of the bank's share price. So that's good news for investors. And then just for the bank itself, its strategy, obviously it's been put on hold because backing their foreign subsidiary with 100% pure equities means that it had put a bit of a brake on broader strategy, potential M&A. So that now we'll be able to see UBS and its board and management will be able to map out the strategy of the bank a bit better.
Miriam, thank you so much for the terrific briefing. We'll have plenty more, of course, throughout the day when we have the results of the vote. Miriam Belezu on, of course, this voting in Switzerland and the impact on UBS. Now, after decades of winning over Chinese buyers with German engineering, Mercedes, BMW and Volkswagen are facing a sales problem. European automakers are racing to recapture share in China's domestic market, where local electric vehicle brands are winning over customers. So let's get more with our Bloomberg Autos and Transport reporter, Danny Lee. So, Danny, good morning. How bad has it gotten for German brands in China?
Yeah, good morning, Fran. It's a pretty grim reading for Volkswagen, BMW and Mercedes, particularly when you focus in on the premium lineup, the premium brands overall. It is a real struggle. Here's a data point or two for you. From 2020 to 2025, the fact that Audi, BMW and Mercedes have seen their market share in China drop or cut by roughly half in some cases. Now they're down to single-digit figures, high single digits, but it shows how far they have fallen and the struggles they are facing. Even in 2026, over the last couple of months, we have heard guidance from these automakers warning of their 2026 expectations not going to meet their reality, purely because, in large part, the fact that their sales in China are struggling. You have seen this competition for over many years now from China come to the fore, and the fact that in the premium segment they cannot cut it when you look at the EVs of a premium nature that the Chinese are churning out, that are better in tech, better in performance, cheaper and overall much more robust. And that is why there has been a huge transformational shift. And you have seen the German vanguard of the auto industry now to crossroads where they have more of the gasoline cars that are struggling against the EVs, and they're all trying to catch up.
So, Danny, what are they doing to fight back, and is it working?
Well, what we have seen so far is at least the models that are being pushed out into the China market are getting close to at least the performance, and in some parts of the tech, clearly, or you've got buyers, Chinese, but who are not quite feeling the same feeling in a Western-made car in terms of the EV performance. They are definitely the Germans coming down closer on price, but it's still not quite there. You do have to look at someone like BMW, their own 11 billion euro investment in new class, this EV shift they're making. That is hotly anticipated because it's expected to even match or beat the Chinese EV makers. So there's a lot at stake for all of these premium brands, and clearly we'll have to watch the likes of BMW, how that reception they get in the China market can translate into higher sales, because it hasn't worked for the likes of Mercedes, and they really are all struggling at this moment in time.
Danny, thank you so much. Danny Lee there with the very latest, of course, on carmakers. Now, global hotel chain IHG Intercontinental Hotels has reported pre-tax profit for the first half of the year that beat analyst estimates. Well, joining us now for more is Chloe Melly, our EMEA earnings specialist. So, Chloe, what actually stood out to you?
I think the main thing for me was really the strength in the US market, because growth in that particular region, the Americas region, was growing ahead of all the other geographic segments. And so that was driven by two things in particular. There was a real strength in the US economy, and so that is translating into healthier kind of travel demand. And then at the same time, there is the one-off boost of the World Cup, where, of course, there's demand for hotel rooms in all of the US cities where all of those games were held. And so this strength in the US, alongside a pretty good growth in China, pretty good growth in Europe as well, that helped to offset the impact of the war in Iran on the Middle East region. So there, it was still very weak, and that will still continue to be weak probably, but it's only about 5% of IHG's business, and so it has really benefited from this US exposure, from this resilient kind of travel demand globally, and the fact that it's not that exposed actually to the Middle East.
Yeah, and Intercontinental is quite a strange company. I mean, not strange, but it's quite well diversified, right? Because it has really fancy Intercontinental hotels, but then it also has a Crown Plaza, which I get is for like midsection business travel, and then the Holiday Inns, and that's like road trips and stuff like that. What are we looking for in the quarters ahead?
Yeah, so for the quarters ahead, obviously, we still have this big question mark over what happens in the Middle East. Those tensions are still there. We don't really know when that recovery will happen. And then, of course, the World Cup boost was, of course, as I mentioned, a one-off, which means that they will not be appearing in the next few quarters. But then in terms of the long-term potential growth drivers, we're actually looking at places like Asia, where there's increasing wealth in places like India, which means a real boost to travel demand. And so that's one area that could be really in focus for IHG going forward as well.
What are peers doing?
Well, peers are not doing as well. So if we take Accor, for example, the French hotel operator, there the second quarter was actually much weaker, but that's because it's the most exposed to the Middle East out of all the European hotel operators. And so it's really been kind of dragged down by that a little bit, and doesn't have as much of a US exposure as IHG does. So this is really about which markets those companies have access to, which markets they're present in, and how they can really think about this shifts in travel patterns as well globally.
Chloe, thank you so much, as ever, for joining us. Chloe Melly, our EMEA earnings specialist. Now to some other top stories we're following this morning, and British shoppers pulled back during the July heat wave. Retail sales increased an annual 1.3%, half the pace recorded a year earlier. Now, food sales were boosted by England's World Cup run. It was pretty good, but non-food sales fell for the first time since April as shoppers postponed big-ticket purchases. Now, the U.S. mainland has recorded its warmest month on record. The average temperature in July was just under 25 degrees Celsius, narrowly beating the previous record set in July 1936 during the Dust Bowl. And President Trump has renewed efforts to overhaul the U.S. childhood vaccination schedule, recommending that the combined measles, mumps, and rubella vaccine be split into separate shots. Now, Trump has connected the issue of vaccinations to rising rates of autism amongst U.S. children, despite the fact that scientific evidence has shown no link between the condition and immunizations.
I came in and I said, I want to find what's going on with autism. It's many, many times what it used to be years ago, and it gets progressively worse, and we add progressively more and more vaccines.
Well, reporting by the Washington Post and the New York Times claims President Trump left Turkey on a secret military flight due to an assassination threat from Iran. Well, President Trump was in Ankara last month for a NATO summit, and the White House has said that he left the country on Air Force One. The Times claims Trump hid inside an airport catering container and was taken to a military jet. Ukraine has attacked a major refinery and a petrochemical plant deep inside Russia, adding to the pressure on the country's downstream industry. Well, meanwhile, Russia attacks on Black Sea ports mean Ukraine's agricultural shipments could fall by more than half this season. Well, let's bring in Jaroslava Barbieri, research fellow at Chatham House. Thank you so much for joining us. Jaroslava, give me a sense of actually where is Ukraine right now economically?
I mean, certainly Ukraine faces huge economic constraints because of the total war waged by Russia. And so what's important to stress is that despite the continuation of the war, Ukraine is very actively thinking of its recovery. So it's really not a post-war process exclusively. It's a process that's starting now. And of course, key constraints include labor shortages as well as manpower shortages. And there are a number of ongoing processes to reintegrate veterans and really see the long-term potential that they could play also for Ukraine's recovery. But it's also thinking about implementing a number of programs to attract back people that have left the country, particularly since 2022, in a way, and revitalize Ukraine's struggling labor market. So there are a number of processes that Ukraine is already thinking right now, but certainly, despite the very welcome EU assistance to back up not only Ukraine's military defense, but also its budget, Ukraine is struggling to an extent.
How has the nature actually of the war changed?
I mean, we're certainly seeing a new phase of the war with mass aerial bombardments from Russia, with an increased use of ballistic missiles, deliberately targeting critical energy infrastructure and civilian infrastructure. But what's important to stress is also that Ukraine has increased long-range strikes targeting particularly Russian oil refineries, dual-use supply chain, strategic air bases, really in order to cripple these dual-use supply chains, but also effectively the lifeline of Russia's war machine. And as we see an increase in Russia's aerial bombardments, unfortunately, Ukraine currently is facing huge shortages of air defense systems. So Russia is trying to exploit this vulnerability that Ukraine currently is facing.
Jaroslava, I mean, where are we in the war exactly? It seems that, Ukraine is doing quite a lot of progress. I don't know if it has the upper hand. I don't know whether it has the upper hand for a long time or whether Russia could actually see a reversal. Like, how would you describe the next couple of months as we get into the winter?
So Russia is making incremental gains, particularly in the Donbass, but we're not seeing any strategic breakthroughs. And as we heard yesterday, a statement from the Russian deputy foreign minister, Russia's maximalist objectives have not really changed. Russia certainly will not seek to freeze the front line before winter, when it will try to exploit this current shortage of air defense system Ukraine faces to try and really demoralize the population and try to make further gains, particularly on the Eastern Front. Ukraine has managed to gain significant, has made asymmetrical gains, particularly we saw recently with the strike on the Barbieri's storage facilities, in a way the Russian Amazon equivalent, that is part of Ukraine's strategy not only to suffocate Russia's war machine, as we saw with the systematic targeting of oil refineries, but really bringing the war home to Russians and ultimately crumble this carefully crafted image created by President Putin as a leader that can protect the Russian population and isolate them from the reality of war. This is no longer the case.
Mm-hmm. How would you describe the relationship today between President Trump and Zelensky?
Well, we've certainly seen a more cordial and transactional dynamic between the two presidents, particularly with President Zelensky's recent visit to Washington. Certainly, it's an improvement compared to the fallout we saw in February 2025. Nonetheless, it has to be said that President Trump has walked back on its initial promise to grant Ukraine license to to domestically produce Patriot missile defense systems, particularly now that Ukraine faces these huge defense shortages, and also has refused to provide Ukraine with an emergency package of Patriot missiles because the US itself faces shortages, particularly due to depleted munitions in the context of the Iran war. Nonetheless, we do see a continuation of US provision of intelligence that is a crucial component of Ukraine's ability to continue in conducting these deep strikes inside Russia, but also the US continues to allow European partner countries to purchase US weapons through the Pulse system.
Jaroslava, overall, how decisive? I don't know whether, you were surprised by the fact that European countries are still, together in this and are supporting Ukraine, giving money. But how much longer can Ukraine fight without U.S. support, or at least without U.S. money? Because at the moment they have U.S. support, but they don't have their money.
They do have European money, though. So the EU has approved a huge 90 billion euro support package that will cover both Ukraine's defense need, but also cover its budget gaps. So for the next 18 months or so, financially, Ukraine can sustain the war. However, what we're seeing is certainly this understanding that the war might continue for much longer than everyone expected. And certainly the expectation is that Russia is not planning to end the war anytime soon. So Ukrainians are bracing for a much longer war. Even when you look at recent survey data, there's a long-term optimism in terms of the country's ability to become a prosperous European countries, but in the short term, the majority of Ukrainians expect the war to last much longer. This certainly has an effect on people's morale, but the country has faced enormous sacrifices. And so what matters the most is really approaching an end to the war that is just, and really make sure that those sacrifices were not in vain.
Jaroslava, thank you so much for joining us. Jaroslava Barbieri, a research fellow at Chatham House, with the latest on Ukraine and Russia. Now, coming up, the yen wipes out half of its rally from recent interventions by Japan and the US. So we'll get more with Ven Ram from our MLive team. That's coming up shortly, and this is Bloomberg.
Responsible and proactive public finances is a policy aimed at strengthening Japan's supply capacity and productivity while attracting greater investment into Japan. As investment in Japan and yen-denominated assets increases, demand for the yen will naturally rise, as I mentioned. I therefore do not see responsible and proactive public finances as a policy that leads to a weaker yen. And on the contrary, I believe it can put upward pressure on the yen.
That was Japan's growth strategy minister speaking exclusively to Bloomberg, weighing in on the outlook for the yen. Now, Japan's currency has now lost half of its rally from recent interventions by the U.S. and Japanese governments, with traders on alert for further support as it nears that 160 per dollar level. Now let's bring in Ven Ram from our MLive team. Ven, good morning. Thank you for joining us. So the yen seems to be slipping back again. Has the intervention failed?
Morning, Francine. Yes, certainly from the looks of it, intervention is not working at all. The minister told Bloomberg that, look, the yen faces natural upward pressure. It's a bit of a pipe dream at this stage because clearly it's not happening. And there's a message from the markets to Japan, which is that, look, you can intervene in the currency markets as often as you wish. And they've intervened to the tune of almost $150 billion over the past couple of years. And clearly that doesn't come to the rescue of the yen. So the latest intervention is going to go the same way. If you look at the 1 month returns on the yen after intervention over the past 5 episodes, the yen has produced little to no gains 1 month afterwards. So I don't think this is working. They can't have a situation where they are compiling supplementary fiscal budgets, and at the same time the Bank of Japan stays behind the curve and continues with this monetary accommodation when it should really be raising rates. Unless they do that, all this yen intervention is going to be optics and a lot of effort for nothing in return at all.
Ivan, we just heard this Japanese growth strategy minister, right, speaking to Bloomberg, and he basically said that the spending plans will provide a long-term boost for the yen. I mean, will it work?
Well, the long-term boost will have to come from what they do with inflation, what they do with rates. I mean, the Bank of Japan itself thinks that, inflation is going to accelerate, and with more fiscal spending, they need tighter policy. Whereas they are thinking that, they could get away with monetary accommodation. That's not going to work. And until the JGB problem is fixed, the yen won't be fixed, regardless of what the growth minister says.
Then, I mean, tomorrow's a big day, right? Really, really big day when it comes to inflation. I mean, will tomorrow's inflation out of the U.S. actually, change the Fed's thinking?
Well, I think it's going to take a considerable upside beat to persuade the Fed to move on rates, because what we have seen so far is that 5 years of missing the inflation mandate hasn't forced Kevin Warsh to raise rates. Even though it's been a good couple of months since he took the helm. So if they're going to look through that kind of inflation overshoot, what is to cause them to step on the gas and raise rates just now when the jobs market is showing signs of cracks? So I think that, the number will have to be convincingly an upward number for them to show any alacrity here.
Do you think actually treasuries face a difficult year-end?
Well, I definitely think that, long duration isn't yet in vogue. And if you look at treasuries today, they're selling off and the 30-year yield is nudging towards some historical highs. So I think that, the markets are saying very clearly that fiscal profligacy is not something that they condone. And that too at a time when inflation has been above target, as we just discussed, for years on end. So there is a price to pay, and the price is being paid by Treasury bond holders.
Then, very quickly, Bank of England, what are you expecting from now until the end of the year?
Well, the markets are pricing in oodles of rate hikes. I don't think it's happening. What we heard from the Bank of England governor, he told you, Francine, after last month's meeting that, look, I mean, the Bank of England is not in a hurry to raise rates, and if they continue with that path, I think that the sell-off in bonds will correct itself, and I think that bonds have kind of oversold, over-expecting what the Bank of England is going to do. I don't think that the Bank of England is necessarily willing to raise rates as much as the markets expect them to.
Ven, thank you so much. Ven Ram there from our MLive team with some great analysis, of course, on what's happening with the currency markets. Up next, it's a Bloomberg Brief. Of course, a lot of the focus will be on that inflation data out of the U.S. A lot of the focus is also on a lot of the news that we had from some of the tech companies, Intel raising $20 billion for AI plans, and then a couple of other things. For example, Nvidia tapping Wall Street for $500 billion of funding commitment. So there will be a full breakdown of all those stories next. This is Bloomberg.